This is for educational purposes. There's nothing being solicited. I am a investment advisory representative with Financial Network Investment Corporation, and securities and investment advisory services are offered through Financial Network Investment Corporation. So let's talk for just a minute on rising interest rates and the effect it has on stocks. When we buy stock, we are fundamentally at the core, we are buying our claim to the earnings of that company. Doesn't always feel that way, but if I go out and buy some shares of ABC stock, what I want is when they earn money, I want to have either a dividend, or I want them to take that money and I want them to reinvest it, and by reinvesting it, the value of the stock should rise, right? So I want to have a claim on the earnings. So when you see the word PE ratio, price to earnings ratio, that means the price of the stock divided by the earnings, and that is a measuring stick for value for stocks. Another word that you hear used is called earnings yield. And we've used this on our conference calls in the last 6 months, but earnings per share divided by the price per share. So here's an example of how to kind of understand these two pieces. So if a stock is selling at $100 and it's earning $7.62, you do the math, that's a price to earnings ratio of 13. And 13, interestingly enough, is exactly where we're at right now on the S&P 500, selling at 13 times earnings. It's selling at 1,300. The analysts believe that the S&P 500 is going to earn $100 a share this year, and consequently we are at 13. The other way of looking at that, though, is saying, all right, for every $100 that I invest in one of these companies, if they're going to earn 7.62%, that's a 7.6% earnings yield. Now, do I get 7.6%? Not necessarily. I might get some of that as a dividend, and maybe they'll take the other part and reinvest it, and the value of the company would increase, but earnings are truly there. I mean, we are $100 per share S&P 500 earnings is $12 higher than the highest it's ever been in a calendar year in history. That's a lot of earnings growth. And it's being driven by low interest rates, inflationary monetary policy, loose money, and the ability for companies to say, hey, we got 9% unemployment. That means you and you and you, we're going to let you go, and we're going to hire you and you and you, and we're going to pay you half as much as we're paying them, and you'll say, where do I sign up? I mean, unfortunately, that's what's kind of occurring. Until unemployment comes down, we don't think that's going to change. But this is the case for buying stocks. Now, the effect that rising interest rates have on stocks is a little complicated, but you kind of follow me here. If you have an expectation of what your stocks are going to earn as a yield, and that's already out there in the marketplace, I think if I put $100 in a stock, I'm going to get 7% in earnings this year. At some point, when I'm trying to decide how much pie I should put in stocks compared to risk-free assets like cash or government bonds, which definitionally may not be risk-free, but there is this thing that goes through my mind that says, okay, if interest rates are, if the risk-free rate, for example, in a CD is 2%, and the earnings on a stock is 7 or 8%, and the earnings yield, then as interest rates go up, all right, then this excess return that I'm getting paid to take the stock risk, it actually goes down. You follow me? That goes up, then the excess return. And if that occurs, I have less and less and less incentive to buy stocks. Because why wouldn't I just put my money in the bank? Okay, so rising rates at a certain point, at a certain velocity, actually hurts stock prices. People say, well, why would I put my money in stocks? I can get more and more in the CD market. So we think rising interest rates might not be good for stocks for the long run. Well, as good, because it depends on how fast they go up.
The S&P 500 index is a widely recognized measure of the U.S. stock market performance. It is an unmanaged index of 500 common stocks chosen for market size, liquidity, and industry group representation, among other factors. The Barclays Capital U.S. Aggregate Bond Index is an unmanaged index that covers the U.S. dollar-denominated investment-grade fixed-rate taxable bond market of the SEC-registered securities. The index includes bonds from the Treasury, government-related, corporate, mortgage-backed securities, asset-backed securities, and collateralized mortgage-backed securities sectors. Barclays Capital U.S. Intermediate Government and Credit Bond Index is an unmanaged index that includes U.S. Treasuries, government-related issues, and investment-grade U.S. corporate securities with remaining maturities of 1 to 10 years. Barclays Capital U.S. Long Government Credit Bond Index is the long component of the Barclays U.S. Government and Credit Bond Index and is a widely recognized index which features a blend of U.S. Treasury, government-sponsored, U.S. agency, and supranational mortgage and corporate securities limited to a maturity of more than 10 years. The Barclays Capital U.S. Corporate High Yield Bond Index is an unmanaged index that covers U.S. dollar-denominated, non-investment grade fixed-rate taxable corporate bond market securities. Citigroup 1-month Treasury Bill Index measures monthly return equivalents of yield averages that are not marked to market. This index consists of the last 1-month issues. Returns for this index are calculated on a monthly basis only. The Consumer Price Index is an inflationary indicator that measures the change in the cost of a fixed basket of goods and services, including housing, food, electricity, and transportation. The Sharpe ratio is a measure of historical adjusted performance calculated by dividing the fund's excess returns by the standard deviation of those returns. The higher the ratio, the better the fund's return per unit of risk. Investors cannot invest directly into indexes. The performance of any index is not indicative of the performance of any investment and does not take into account the effects of inflation and/or fees and expenses associated with investing.